Ladies and gentlemen, thank you for joining us today on the second day of 8th Indonesian Finance Association International Conference. There are still IFA boards present here today with us for the second day of the conference. We still have Prof. Ted, Prof. Irwan, Professor Dirk Bohr, Ibu Irmawati, Dr. Putu Anom, and also Ibu Retno Ichi, who are here today. We are very much delighted to be here again today to continue with our conference day. We still have parallel sessions until 4 p.m. Indonesian time. Please fill the attendance link of each session for today's plenary sessions in order to get the conference certificate. The link of the presents will be shown on the screen. And at the end of the conference, we will also present the award to the best paper and the best thesis at the closing ceremony. We also have 3 smartphones as door prizes that will be given to 3 lucky participants that stayed until the end of the conference. Ladies and gentlemen, to start the day, we will have Head of Business Incubation Division, Indonesia Stock Exchange, to start the first plenary session of the day. This plenary session will be moderated by Dean of Faculty of Business and Economics, Universitas Surabaya. Please welcome Dr. Putu Anom Mahadwarta, MM, CSA, CCIB.
Thank you very much. Thank you, Mrs. Tantiana. Okay, sorry. Good morning, distinguished participants. Our participants from Indonesian Finance Association, Mrs. Irmawati Amran. Nice to knowing you. Yes, we meet several times in Teach Me. So my name is Anom. I will become the moderator for this session. We have here the speakers, Mrs. Irmawati Amran. She graduated from Master Management Program, University of Indonesia, which is I'm also graduated from there. I graduated at 2000. Mrs. Irma. So I'm your juniors as MMUE. So Mrs. Irmawati have a career from 1992 in Indonesia Stock Exchange. Today, she's head of Business Incubation Division that charging for strategic project in Indonesian Stock Exchange, and also currently serve as President Commissioners at PT Indonesian Capital Market Electronic Library, or Teach Me. Time for you to present your session in a plenary session is about until 1.5 hours, until 10:30. We have about 30 minutes or so to discuss or to hear the presentation, and then we have a discussion until 10:30 a.m. Please welcome Mrs. Irmawati Amran.
Thank you, Dr. Putu Anom. Thank you very much. Good morning, ladies and gentlemen. I'm very pleased to be here to present how the Indonesia Stock Exchange implement IT, information technology, to increase the growth of the capital market. Pak Eko, please, can you present the presentation? Okay, thank you. My presentation today is how the digital transformation then increase and to promote the growth of capital market in terms of Jakarta Composite Index and trading value. I will begin next slide, please. I will begin my presentation today by taking you through the journey of IDX since its founding in 1992. On this chart, we can see the red dots, so IT-related milestones. And I will focus on IT-related milestones to see how they affect the Jakarta Composite Index growth and the transitional value. IDX was founded in 1992, and at the time organized manual trading, still manual trading using whiteboards with an average daily trading value of around IDR 31 billion, very small number, and the Jakarta Composite Index at 321. We started from that point. And then IDEX started computerization in 1995, where around 400 traders traded from the trading floor using personal computers, which are connected to the central trading engine server in our office. Since the computerization, the volume and volume of trade began to increase and was able to survive during the 1998 economic crisis. We can see on this chart that IDX at
Excuse
the time.
Excuse me. We cannot see. Can share the screen, please, because your presentation is not appear in our screen.
Oh, I'm sorry. I'm sorry, Prof. Pak Eko.
Mrs. Irma, it's share here, but unfortunately, it's a reshare from other device, so it's kind of blur. The resolution of the picture is not quite
good,
clear to see.
I'm very sorry, Prof. Maybe Eko, can you please do something with the presentation so everybody can see it clearly? I'm very sorry for the technical problem. Okay, I think now it's better.
Now it's better. Maybe we should have a full screen.
Yeah.
And we can see if that already have a clear screen. So can we do a share screen, a full screen?
Pak Eko, please present it on the full screen mode, please.
Okay, that's better.
That's better, I think.
Yes. Please.
Okay. Maybe can I repeat the explanation, Dr. Putu? So we can start from the beginning.
Yes, please.
We can see on this chart. IDX was founded in 1992. Yeah, we start from that point, from the red dot. Here, we see some red dots. They are the milestone of IT related. So I will focus on the IT related milestones here and to see how the IT affect the Jakarta Composite Index growth and also the trading value growth. IDX was founded in 1992. We organized manual trading using whiteboards at that time. With an average daily trading value of around IDR 31 billion and the Jakarta Composite Index at 321. Then we start from that point. We see in 1995, IDX started computerization, where at the time around 400 traders traded from the trading floor using personal computers, which are connected to the central trading engine server in our office. Since the computerization, the volume and the value of trade began to increase and was able to survive the 1998 economic crisis. You can see on this chart, the charts are quite good on the time. And IDX began intensively developing technology after preparing the entire system for the new millennium before we come into the year 2000. And in the year 2000, exchange our members started computerizing the back office system, and IDX at the time started scaleless trading. And then IT development continues and trading activities began to shift from the trading floor to remote trading in 2002. IT development continues And we see from trading floor to remote trading, so that the number of traders who can trade was increased, and the settlement day was reduced also from 4 days to 3 days. Since then, we can see from the chart here, the average daily trading value and the Jakarta Composite Index then continue to increase, even though they have to stop in July 2008 during the global financial crisis. At that time, was tough. But at the end of the 2002, the average daily trading value was about IDR 500 billion. And now in 2022, it is the trading value, the average daily trading value is around IDR 15 trillion. So it is growing 31 times over the last 20 years. So IDX shows the remarkable long-term growth, and we can see from this chart, we can quick recovers after some crisis that make the Jakarta Composite Index decline at the time. The digital transformation of exchange members trading began with the implementation of online trading in 2010, and we can see the impact here. Since 2010, we see the chart here. The growth chart of average daily trading value increased sharply, and the Jakarta Composite Index also rose sharply. To increase the growth of investor access to the capital market, since 2019, our exchange members have begun to develop digital application so that investors can open accounts online. This development makes it easier for domestic investors to start investing in stocks, and then the IPO system, the electronic IPO system, is implemented in 2020 to increase the retail investor participation in the primary market. So, ladies and gentlemen, this chart shows us how IDX start from the beginning, from the manual trading to the remote trading, and then to the online trading. And now we also have what we call electronic IPO system that can help the investor to easy access to the primary markets. This slide, I would like to show you how we are facing the challenge of increasing the number and activity of local investors in IDX. The red bar graph shows the number of stock investors. In 2016, the number of stock investors was about 536,000, and the total number of investors in the capital market, including bonds and mutual funds, was around 894,000. This is a very small number compared to Indonesia's population at the time of around 260 million. The very small number of investors, apart from the limited reach of educational media, is also caused by the difficulty of opening investor accounts. As I said earlier, since 2019, exchange members have started implementing online account openings that make it easier for investors to open stock accounts. Currently, there are 33 exchange members who have provided online account opening services. We can see in this graph, in this chart, the number of stock investors increased sharply in 2020, growing by more than 100%, from 1,695,000 to 3,452,000 in 2021. Total investor in the capital market, including bonds and mutual funds, increased 92.9% from 3,881,000 in 2020 to 7,489,000 in 2021. The number of active investors also grew high from 2020 to 2022, both for daily and monthly investor activity. So from this graph, we can see how the technology, how the digital transformation affect our capital markets in terms of the investor number. Investor number in Indonesia is a big challenge for us because compared to population of Indonesia, actually the investor number is still very small. On this chart, on this slide, I would like to show you how opening an online account make it easier for investor to access the capital market, especially for stock investment. Previously, before we have opening online account, to open an account, investor had to come to exchange member office. This alone made it difficult for investor. The KYC process takes 30 minutes, and delivery of hard copy documents to the head office can take 1 to 7 days. Now, by opening an account online, investors only need to open an application on their mobile phones, and within 40 minutes, investors already have a stock account, compared to the previous one, which took up to 7 days to open the stock account. So this is very innovative development in our exchange member to increase the number of our investors. Next slide. We can see how online here we see online trading run by exchange members also greatly encourages retail investor transaction activities. In 2010, there were 41 out of 119 exchange members, approximately 34.45% had started to implement online trading. For more than 10 years, the number of exchange members who implement online trading is increasing. In 2022, now there are 71 out of 94 exchange members, almost 60% have implemented online trading. So now the device is on the investor's hands. Investor can invest stock whenever they like to do it. So we hope this investor activity can increase more and more in the future. In this slide, I would like to show you the local investors that are already leading the market. Ownership of shares by local and foreign investors is now quite balanced, and the value of share transaction made by local investors exceeds the transaction made by foreign investors. In 2021, local investor transaction reached 74.82% of total transaction. We believe that the strength of local investor can maintain the resilience of the Indonesia capital market. Next slide. On this slide, I would like to show you the growth of retail investor transactions. Here, I display the data for the last 5 years. The total transaction value of retail investor grew from 33.9% in 2017 to 56.2% in 2021, up 66%. And until August 2022, the transaction value of retail investors reached 46.7%. The number of shares owned by retail investors has also increased significantly over the last 5 years, from 8.6% in 2017 to 14.1% in 2020. It's up 64%. On the next slide, well, ladies and gentlemen, before we go to this slide, I would like to give my impression of the contribution of our retail investor that increased rapidly over the last 5 years. We believe this is due to the use of digital technology that is applied that makes it easier for investors to invest in our capital market. This slide, I will show you another aspect of the implementation of technology in our capital market. In addition to developing technology to increase retail investor activity in the secondary market, we also developed a system to increase retail investor activity in the primary stock market. In 2020, Indonesian capital market started implementing the electronic IPO system. We call it EIPO, stands for Electronic Indonesian Public Offering. It was developed to increase the ease of access for investors to participate in the initial public offering process, from the process of book building, offerings, until allotment. Previously, in an initial public offering process, it was still difficult to do ordering shares in the primary market, especially for retail investors. Even for certain investors, the available access to participate in an IPO was very limited and not affordable by investors outside Jakarta, because investors need to come physically to place an order. The EIPO system provides many advantages and conveniences for retail investors because it is a web-based system. All investors can participate, and there is a portal providing complete information about issuers conducting the IPOs and other relevant information. Next step, please. Ladies and gentlemen, before we implemented EIPO, the retail investor find it difficult to participate in the primary market. The number of investors who receive the allotment of shares very, very small. An investor can only order initial shares through syndicates. So the investor can only order shares through underwriter and sales agent. After the implementation of EIPO, it is easier for investors to participate in the primary market, increase the opportunity for investors to obtain allotment of shares, expanding the participation of securities company as selling agents in the public offering process, not only as syndication, increase the number of shareholders after the IPO to support stock trading liquidity in the secondary market after the public offering, and improve the ease of monitoring by regulators to establish a more transparent public offering price. Next slide, please. After the implementation of the EIPO system, the average number of investors who receive an allotment of shares in the primary market increased sharply. Before using the IPO system, the average investor number who received an allotment of shares was only around 1,000. You can see on this chart, in 2021, since the IPO has been actively used, the average investor allotment for each IPO process has reached to 12,301 investors, and once reached 288.96 288,960 investors during the IPO of GoTo. And until September 2022, the average investor allotment reached 21,765 investors. So EIPOs have provided benefits to our market and wider opportunities for investors, such as the opportunity for retail investors to obtain shares in greater. To obtain shares is greater. There are more selling agents, so it is the opportunity for the exchange members. So because now all the exchange member can be the participants of EIPO, so they can be selling agents for every IPO process. The number of shareholdings after the EIPO increased compared to before the EIPO. And the distribution of the provinces has covered the whole of Indonesia, whole provinces. Investors from the whole province can access the EPO process, can get allotment from EIPO. And also the access from abroad has become easier, of course. Next slide, please. Ladies and gentlemen, the distribution of information from issuers to investors is also an important part of the entire business process. Utilization of IT system in this process provides benefits not only for the speed of information dissemination, but also for data processing to become easier for investment decision making. ADX has a system, namely ADXNet. It's a system used to facilitate the electronic submission of issuer financial reports and also can be used by issuers to submit corporate action information. ADX also has implemented extensible business reporting language. We call it XBRL. XBRL is a global recognized electronic communication standard for the transmission and exchange of business information. So by implement XBRL, we can improve the accuracy, efficiency, and automation of the monitoring of the listed companies' reports. The data presented can be directly read and analyzed through an application or through computer application or digital application or in a business intelligence dashboard. Next slide, please. Ladies and gentlemen, we are facing the futures. ADX will continue to do research in information technology and try to find what opportunities can be exploited. ADX has a lot of data from various sources, such as transaction data, data about issuers, data about investors, and many others. There's also a lot of information about the capital market in online media. Big data analytics and machine learning are the technology that we will be leveraging in the future. What I see is that big data analytics and machine learning can be used to perform analysis to see some trends for decision making. Some aspect that I think can use big data analytics or machine learning in capital markets, such as for issuers, for company valuation, going concern and track records, for market surveillance, for detection, investigation, and analysis of transaction patterns that harm the market, for action members, for analysis of the financial resilience and compliance, and for investor, we can see the trend of the trading behavior for develop some programs for our investors. Ladies and gentlemen, this is the last slide of my presentation. I thank you for your attention. I give it back to Dr. Putu, please.
Thank you very much, Mrs. Irma Wati Amran. So you're presenting something that use like the increase or the progress of the Indonesian capital market. We can see here that you have a strategy to increase more investors. You also maybe discussing about the EIPO, all the and then also we know that capital market will always have a way to doing business more efficiently, using ease of use of digitalization and also ease of use of the network and software that we already know now. And the most challenging part maybe will become the security of the system that make our investors eager to enter the capital market. But last but not least, we also congratulate the Bursa Effect with the 4.1 million investors. Yes, it's 4.1, right, Mrs. Irma? Until mid 2022, it's 4.1. Okay, now we open the discussion and question from the audience. Maybe several of you have a question to Mrs. Irma. Please have the Q&A in a Q&A session, and also raise the hands for one of you who want to ask a question to Mrs. Irma. Maybe from for me, Mrs. Irma, I will start the discussion. First thing is about I know that Indonesian capital market have a very strong strategy to penetrate the market and increase more youngsters to enter the capital market, right? So you have also we have a lot of online securities firms that you say that it's they can open the account for about 7 minutes or 15 minutes or less. And I already use that, and I can open the my account, RDN account. It's about 7 minutes. I take a picture of me and my license, and then that's it. That's an account there.
So everything is in your hand, Prof.
Yeah, that's a very good, very great increase in the how we have to eagerly increase the investor side. But maybe my point of view is about what is about the security for these investors, so they will know that how we or the capital market have any strategy to increase the awareness of the security problems in our systems, or to make them more eager to enter the capital market. Please, Mrs. Irma.
Thank you, Dr. Putu. Yes, IDX has guidelines for our members to do their online trading and all their system. The member can launch their application only if they have approval from IDX. So IDX does the assessment of the system. We come to their system, we audit their system, the information system, the security, all aspects of the security, cyber security, all of them, until they get approval from IDX. So that's the strategy we do to reduce, of course, the risk of technology, the risk of security of technology in our capital market. So it's not quite easy, I think, for the Action member to launch their application, because they need to have our IDX approval first. Dr. Putu.
Okay, thank you, Ms. Irma. We have here Professor Irwan Adi. You raise your hand. You have any question, please, Professor Irwan.
Yes, thank you, Dr. Putu and Bu Irma. Good morning to you all. So I have a question with regard to the retail investors. It is so interesting that the number of retail investors, if I'm not mistaken, by August, the total investors are more than 9 million from the slide. Is that correct? Or uh, okay, I hope that's correct. Anyways, my point being, I see that the ownership of retail investors, although they are increasing in number, but in terms of ownership, it's only about 15% from the slides, if I'm not mistaken. But their transaction is more than 50%. So it seems that the retail investors, they tend to trade a lot. They tend to buy and sell a lot instead of holding the stock for a longer period of time. So they're not expecting to get long-term dividends, for example, but they tend to chase capital gain. My concern or my question is, do you think the volatility of the market will be impacted by that active trading of the retail investors? And if so, are you worried about this transitory volatility in terms of quality of the market? That's my first question. Secondly, you mentioned also there are some transaction level data and probably even account level data that is available from the IDX. My question is, as an academic, I'm sure this is also the question from a lot of us. Can we take advantage or use the data to do some research in the capital market? And if we can do that, is there any certain procedure, or is there probably any way that the Indonesian Finance Association can cooperate with TeachMe to get the data, and not the confidential ones? I mean, we don't need to know the final owner or the name of the account holders. It's just that their status and their classification, whether they are foreign or domestic, individuals, corporate, etc. So that's my second question. Thank you.
Thank you, Pak Irwan. The our domestic retail investor behavior. Majority of our retail investors are trader. So just especially for the young investor, they are traders. So they actively trading in our market. So then it make the trading value bigger for the domestic. Yes, Pak. The ownership. I think the ownership quite balanced. Domestic and foreign investors, but we Indonesia Stock Exchange see this phenomena as a benefit for us, because when the domestic investor trading more than foreign investor, it keep our market resilience quite stable. Because we know that when foreign investor take their fund out from the country, it affect our market. But if our retail domestic investor active in the market, we hope this can keep our market resilient and stable. Do we afraid of the volatility? Sometimes volatility is good for the market because it makes the market become dynamics. And IDX has a surveillance system that control how the price going up and going down. So our surveillance system, it is also a good system, a globally standard system, can monitor how the price movement, how the volatility of certain stock. So it is under our control. Pak Iwan maybe experience when a stock was suspended because of the volatility. That's kind of how IDX control the market volatility. So we do not worry about the volatility. Volatility somehow sometimes good for the market, for the activity of the market, for the traders, because our investors, not only long-term investor or medium-term investor, but also the market move by the traders. So everything should be in balance, long-term, medium-term, and the traders in our market. So there is no worry to see how the behavior of our investors. And second, about the data, Pak Irwan, you are right. Not IDX, but the custodian central effect has the investor data, complete investor data. So the data, some data are confidential, of course, but for the aggregate data, I think we can provide the researchers to have the investor data. It is quite difficult for KSEI to give the investor data to researchers, to academics, because they have to keep the security of the data. But I think they can give data in aggregate formulation, in demographic. Sometimes how many investors are, how many millennial investors, how many female investors, how many male investors. I think that kind of data KSEI can give to you and to the researchers. But the detail of investor, even though maybe it is not the identification of investor, I don't think they can share the data. I mean, the data one by one of investors, I don't think we can provide it to the researchers. But for the aggregate, I think we can provide the data. Pak Irwan.
Thank you, Bu.
Yeah.
Thank you, Mrs. Irma.
Did I answer your question, Pak Irwan?
Yes. Thank you so much.
Because Prof. Irwan is, we have a fundamental, we have a technical. Prof. Irwan is part of the fundamental side, right? It's a volatility more concern. Retail investors increase the transaction, but also increase the volatility of the market. Yes, of course. So, but the problem is, we also have to increase the volatility because we want to increase the transaction. Is that right, Mrs. Irma? So yeah. Transactions means a lot of people will get what we call a chuan, right?
Yeah, right.
And other people can, let's say, have more opportunity to fulfill their investment goals. So that's maybe part of the why we have to increase our retail investors. Is that right,
right.
Mrs. Silva?
Well, Pak Putu. And IDX, of course, not in the capital market industry globally. We have a lot of products, not only stocks, not only shares. Some products are created to resolve the problem of the volatility, kind of like derivative and stock warrant, we IDS just launched structure warrant. Those products are created to resolve the problem of volatility for hedging. We do not worry about the volatility because volatility makes the market, right? Pak Putu, give cuan to our investors.
Yeah, of course.
No. I think I add something also, right?
Yeah, yes, Prof.
Okay, so why IDX launched the warrant instead of the options?
Structure
Right?
warrant, Prof. Yes.
Yeah,
Yes.
because if the option we can have a put and call, right? This is the we can I mean for hedging usually we can use a put, right?
Right, Prof.
Right, and I think the IDX is planning now to launch the option again because we already have before, right?
Right, Prof. IDX has launched the option market, if I'm not mistaken, in 2020, before 2000, and then relaunched in 2009, if I'm not mistaken. But this option product is quite complicated for our investor, Prof. So that's why our products didn't work at that time. Then we start from for the derivative market. Then we start from the index futures, and index futures. The index futures also didn't work because our members, because the lack of a capacity of our members about the derivative market. Then structure warrant. Structure warrant is not the derivative products, but we call it as the structure product, Prof. It is not that complicated as derivative products, not that complicated as option product. So we decided to start from the structure warrant before we come into the option and for the option market. Structure warrant also has put, Professor. We have a call structure warrant and put structure warrant, but we started from the call structure warrant first because we want to educate the investor first about the structure product, and then after the investor quite familiar with structure warrant that is quite similar with the option product, then we will come into the option product. That's the reason, Prof, why we do not try to explore the option because it is very complicated for investors, and also for our members. But structure warrant, it's more easier. It's easier. Investor can trade it easier because it is the transaction is about the same with the stock transaction, and also for our members, they don't have to build a new system. Just use the current mobile system, the current application. So we started from structure warrant first, Prof, and we hope if the structure warrants growth increase in a good number, then maybe we can start to implement the option market. But for derivative, we still start from index futures, Prof.
Yeah,
it is more easier
because back in I think in 2010, at the time, I was appointed to be a local consultant for KDI, Korean Institute Development, right? And we did the study, right? Why the option market in Indonesian stock exchange, right, is not grow as we expected at the time, right? And we did some study about it. First one is about we have to prepare the infrastructures, right? The regulations, right? Because we want to make sure, right, the market will be fair for everybody, right? Because the trust is very important, right? If I want to play in the option market, means that I trust the market is fair for everybody, right? The second one, I think also about the price change limit, the limit of price change, right? Because the more volatile the stock, the more interesting to, right, to play with the options. If the price is not volatile, and option will not attractive for, right, the speculators. Of course, I think the most of the option traders, they are speculators, right? It's only few of them is hedgers, right? Right, but they make they make the market more active, right? Because they also affect the stock activities, right? The stock trading activities. So I think if I can suggest, don't wait until everybody know about the option, right? But you just put the option and everybody will start to learn about that. if you if wait until everybody know about the option and we never have the option in Indonesian stock market.
Yes,
Right.
Prof.
So this is
Actually,
just only my suggestion, right?
yes, yes, Prof. Actually,
Okay. Yeah.
we did, and we still have the products, but not active.
Yeah.
Uh, we'll see how the structure warrant now, how it is working now, and we see that the structure warrant, we have three series of structure warrant currently, and they are very active, and we can see that investor start to learn the structure product, and then start from that. Maybe Prof, we can. Maybe in 2 years later, we can
Yeah. Okay. I hope that
implement. Yeah,
prepare all the
implement.
infrastructure that needed
Yes,
for, right, to make sure
yes,
that investor will trust about the option market.
yes,
This is the
yes,
all, right?
yes, yes, Prof.
Okay. Yeah.
The infrastructure is very important, Prof, because now investor trading from mobile phone. Mobile
So
phone.
the
Yeah.
infrastructure, the more important one is not about the technology that we can use, but the regulation.
Oh yes, yes, the
Yeah, it's very
regulation.
because
Yes,
it's
yes,
very important one.
yes,
Okay.
yes. Actually, we still have the regulation, Prof. Now, the option market and derivative markets, but it's difficult to develop the market for the derivative right now.
Okay, Pak Putu Anom, let me discuss with the Pak Dirut, Pak Imam. Yeah, maybe we can do the research about that.
Oh yeah,
Okay.
Yeah.
We can do the
yeah,
research
yeah,
Yeah, we
about
can
that.
do research.
Yes, of
Let
course.
give
yeah.
IFA conduct the research for that, and we can just give to the IDX, right, to consider, right. If this is
Yes, Prof.
already, I think we can discuss with the Pak Iman, right?
Yeah, this is very helpful for us, Prof. If
Yeah.
we have a paper, the research of how the investor behavior, how the
Yeah.
investor concern and interesting in the derivative market, because
because
depends.
because now we can see, now we see that it's the millennial now, right, and they are very much interesting, right, in trading instead of
Yes,
investing, right.
right, right, Prof.
Right, so if they more interesting in trading, and the option is make them more, right, more exciting, right, so you can see about it. So I think that we have more younger investors, so I think
Yes, yes,
it's time now to think about how to launch again the options, right,
yes, yes.
in the
Maybe we
capital
have
market.
to revise our regulation,
Yeah,
Prof.
yeah. Okay. So maybe if need, I mean, through the IFA we can make a collaboration for the research.
That's very will be very helpful
Yeah,
if we have a paper for the investor behavior.
Because we have best researchers, right, in the
Yes,
capital
yes,
market, right, in
yes.
IFA,
We
right?
can see the potential of our investor, yeah, Prof.
Yeah. Okay.
Yes.
Yeah.
Thank you, Prof. Ted. Thank you very much, Mrs. Irma. So we have an opportunity to doing a research, Prof. Ted,
Yeah.
throughout the capital market
Yeah.
about the volatility and also the option models. Okay, that's very good discussion here. So we also from my point of view, Mrs. Irma, it's also about the how the capital market can engage in the financial literacy of our potential investors. So part of that is how we can join our strength together with IFA, and then we can do a lot of programs to, let's say, increase the financial literacy, especially capital market literacy, to our potential investors. That should be a good point of view also, Mrs.
Yes.
Yilma. That's
Yes.
the kind of president commissioners that fits me, right?
Yes, currently, Dr.
Yeah,
Putu,
of
yes.
course.
We
Yes,
can
that's part of
collaborate with Teach Me to educate the people around Indonesia. Yes.
yeah, of course.
Okay, maybe let me try to arrange, right, from the IFA. We can right, try to find a good time to meet with the right, with the okay Pak Iman, right, and the board of director of IDX, right, and we can discuss, right, what kind that the IFA can help also, right, the development of the Indonesian capital markets, right, because right, we have members, right, all the scholars, yeah, in the as a IFA members, right, so we can make a program maybe, right, for the IDX. Let Pak Putu Anom, I will arrange, right, so we can meet, right, I mean IFA as an organization, right, can meet with the IDX, right, and Pak Iman, right.
Okay, thank you, Prof. Ted. Thank you.
That's a good thing.
Okay, so we still have other question from the audience, from the participants, and this question may be part of the representative of the potential investors who look around, who look upon the capital market. From Mr. Elon, he talked about the capital market, especially this is what he wrote: the capital market, especially stock market, is a zero-sum game. That means if someone is winning, then there is someone else is losing. So he also had an opinion that say the more investors or participants join the stock market, they are just going to be victims for the investors that already in the stock market. So what do you think about that, Ms. Irma? That should become one of part of our big question in the capital market literacy, right? Please, Ms. Irma.
Mr. Elon, zero-sum games is for derivative, yes. But for the stock market, no. Stock market is a set on program. Yeah, so it is not zero-sum games. But if you see the investing in capital market as a trader, maybe you see it as a zero sum games, but it is actually not, because if you keep the shares, the stock, and you believe that the company's value will increase, then your asset value will be increased also. So it is not true that the stock market is the trading in stock market is zero sum games. No, but derivative, yes. Derivative, yes, because you have position in derivative. So if you have a short position, then when the price up, then you will lose. So it is, yes, zero sum game. So why derivative is very, very high risk high risk investment. I don't think we can. I don't like to call derivative market as investment, but it is the hedging vehicle for the big investors. So that's my opinion. Dr. Putu.
Thank you very much, Mrs. Irma. So that's maybe one of the representative of how our youngsters or our Indonesian people see the capital market. That's maybe part of your job also in the Teach Me to
Yes, yes.
to discuss that and say that, oh, this is no zero sum game. Yes, capital market
Right.
is not a zero sum games. It's about the financial goals. It's about the investment. It's about trading. So part of that is about how you try to increase your revenues or your current revenues using more prospective or potential income in the future. So that's
right.
become part of the question. So
Yeah.
this maybe that will answer the question from
Yeah.
Mr.
It,
Ilan.
it is our duty, Dr. Putu,
Yes,
because
that's our
we have
duty.
to do a lot of education to our young investors about the truth of the capital market. Yeah, Dr. Putu, we can work together in the future.
The second question is from Mrs. Lydia, asking about the entering uncertainty in 2023. There's any special strategy from capital market to prevent capital outflow? The shifting the traders to the capital outflow from because there is an uncertainty in 2023.
2023.
Yes, maybe you can answer that first. Thank you.
Yeah. As I mentioned before, we because political situation, something that we cannot control, of course. If the political situation next year is not good, maybe then foreign investor will take their fund out of the country. But because we have a very strong domestic investors, then we are quite confident with our market. So our domestic investor will keep our market resilience. And we believe after the political years, then if this and we believe that the condition will be good after the political year, then the money will come back. So it is not our control. It's not under our control about the political situation. But what we can do, what IDS can do, is to strengthen the local investor base to keep our market resilience in good condition. So we, IDX, is still confident with the next year political year. And we hope you, as the local investor, still believe in our market, because the companies, we still positive about our companies, our listed companies. Some of them are still in the good condition, in this good condition, in this situation.
Okay, thank you, Mrs. Irma.
So can answer your question, Lydia.
More about Ms. Lydia's question is also part of the outflow, because we have uncertainty prices in Europe, like what happened in UK, and how the US increased the Federal Reserve. And so there will be a capital outflow from foreign investors to outside Indonesia to let's say return their money back to their homeland. So, but as Ms. Irma said, capital market have a confidence about our domestic market, right? So it means that our own investors will also have a strong confidence with our market. Maybe that part of the views that you are going you try to focus there, right, Mrs. Irma?
Yes. And from history, you can see that our market is quite stable when other markets went down. When the pandemics, during the pandemics, we can see how our market can survive during the pandemic, and we still have a confidence because we have a good currently we already have a good domestic investor base, and we have to maintain it and try so many programs to increase the domestic investor base.
That's right, Mrs. Irma. So before anyone has any other question, maybe I will add a little bit more point for this session. First is this is a very like a question for you, Mrs. Irma. Very simple question. You say that we have about 4.1 million investors, right? So 4.1, I guess, in your PowerPoint. So do the Indonesian Capital Market Board have a target for the end year? How many investors that we have in our capital market? Do you have any target for that
Yes.
in your?
Yes, Dr. Putu, we always have target for investor increase. For the next year, for the 2023, we have a target to increase 3 million investor in 2023.
So it's 3 million plus, right?
Yeah,
3 million plus.
plus.
So it's about 7 million?
2023.
So you think it's about 7 million?
Yes, about 7 million.
Oh, that's a very
aggressive number.
very aggressive numbers, right?
We need support from Eva.
Right. So, well, with that very aggressive numbers of target, yes. 3 million plus investors, do you have any what other strategy that you use to increase those numbers besides to increase the capital market literacy of the investors? What kind of strategy that the Indonesian capital market use to increase those numbers, because it's very aggressive numbers?
Yes, we see that our target is mostly for the millennials. So we will develop a kind of digital media to do the not only the education but also socialization of every for every interesting point to invest in Indonesia. So the digital application is the answer to spread and to speed the information of our capital market. So that's one of our strategy, Dr. Putu. Not only the conventional education in classroom and then social media, something like that, but we are developing a digital application to spread information to people all around Indonesia. And one thing that we will provide next year, the price information. What we know that it is difficult for people to get the price information because they have to pay. They have to pay the application. They have to subscribe the application. Then in 2022, we will launch a mobile application that give price information, that give the fluctuation of the market, give every information, company information in the application for free. So the cost will be the cost for investor will be reduced. So we hope this strategy will make the young professionals more interesting to come to our market.
Thank you, Mrs. Irma. We in IVA, we always support capital market, Indonesian capital market. So you can count on us to support.
Yeah, I mean, if I can give content into our application, Dr. Putu.
Yes, of course, we can do that together. Yes, we can do the content. Eva can contribute to support the content. Several of us also have either a channel of content like podcast. We also have a podcast in capital market. Also have YouTube channels and so on. So part of that is one of how we are going to increase our investors. Thank you very much, Mrs. Irmawati Amran. That's all for our session, the first session and the second day of the IVA conference. Thank you very much also all the participants that already discussed here, Prof. Ted, also Prof. Irwan, Mr. Elon and Mrs. Lydia also have a question there. Hopefully that will wrap up our session for the Indonesian Finance Association in panel session 1. And let's support our capital market. Thank you very much. Have a nice day. Good morning.
Thank you. Have a nice day, everybody. Thank you, Prof. Thank you, Doctor.
Thank you, Mrs. Irmawati Amran and also Mr. Putu Anom. We're going to have a photo session first before we're moving on to the second plenary session of the day. Please position yourself in front of the camera and we're going to take pictures. Okay. Please give your best smile to the camera on the count of 3. 1, 2, 3. Once again, 1, 2, 3. Okay, thank you so much.
Thank you. Yayo.
Thank you, Bu. Okay, for the second session of the day, the plenary session will be brought by a professor in accounting and finance at the University of Western Australia, Professor Dirk Barr, MSc PhD, and the moderator for the session is Assistant Professor at the Department of Management, Faculty of Economics and Business, Universitas Bengkulu, Mr. Roberto Usman, MSc PhD, and the time and screen is yours.
Okay, thank you very much, Miss Yolanda. Hello, everyone. Good to see you again in the second plenary session in Indonesian Finance Association International Conference in conjunction with the 45th Indonesian Capital Market Anniversary. And let me check first if Professor Dirk Bauer is here already.
Yes. Hello.
Okay. Hello, Prof. How are you? Good?
Very good. Thank you.
All right. So again, welcome back, everyone. And it's good to see you. My name is Berto Osman, and I'm going to be the guide for the second plenary session. Before we start the second plenary session that will be brought by Professor Dirk Bauer, let me introduce you to his summary profile. Professor Dirk Bauer is recently a professor of finance at the University of Western Australia. It started from 2016 till now. And prior to joining to the University of Western Australia, Professor Dirk Bauer has outstanding experience. He started his academics life at the Dublin City University as lecturer, and then he worked as senior lecturer at the University of Technology Sydney. And then he was associate professor at the University of Technology Sydney and at the Kuhne University Logistic University of Hamburg. He did his MSc in economics at the University of Tübingen and his PhD at the same university with the concentration financial econometrics. Professor Dirk Bauer also has extensively published his empirical works in many outstanding top journals such as the Financial Review, the Journal of Banking and Finance, and the Journal of Financial Stability. Overall, his research interest is mainly lies at the area of gold, financial contagion, virtual currencies, shadow banking, sustainable finance, dependence modeling, and quantile regression. So Professor Dirk Bauer, you will have probably around 45 minutes for your presentation, and we will keep going with the Q&A session for another 15 minutes. So if you are ready now, you may start, and the screen is yours. Please, Professor Dirk Bauer.
Thank you for the kind introduction. I just noticed that I cannot share the screen, so if you allow me to share the screen.
All right, let me check. The committee, could you please help Professor Dirk Bauer to solve the problem?
Well, that may be why I had to send the slides in advance, which I may have missed.
So which one you prefer? You share the file by your own, or you would like us to share the file?
Well, you don't have the file, so if you can allow me to share,
all right.
I'll send it quickly to Leo.
Okay, so we will give you the access to share the screen.
Yeah.
Just a moment.
Yang 4 poin berapa? Kalau keseluruhan itu memang belum memenuhi target.
I can share now. All good?
All right.
Yeah. So. Almost there, sorry. Show all windows. Where is it? Okay. Good. So sorry for the delay, but I'm ready to go now, and I hope this will be interesting. Can you see this screen?
Yes, it is visible now.
Good, perfect. Thank you. So thanks for the invite again. I'm very honored and very pleased that I have the opportunity to talk about my research today. I picked something that is hopefully of interest to you. It is about portfolio insurance and gold, and how institutional investors or smart money uses gold to insure portfolios. I'm also happy then, because I also do a lot of research on Bitcoin and cryptocurrencies. If there's more interest, then there's also a link there, and we can talk about that later at the Q&A session. So let me start with a quote here to set the scene. In a world of ongoing pressure for policymakers across the globe to print and spend zero interest rates, that's kind of not true anymore, right? But the tectonic shifts in where global power lies and conflict, that's still true. And gold has a unique role in protecting portfolios by famous investor Ray Dalio. And before I go into the topic, I also want to clarify, I mean, you may all know that, I'm sure you all know it, but I also had a quick look at what the World Gold Council sees reports about Indonesia's role in the gold market, in the global gold market. The jewelry consumption here rose year on year by 18%. The bar and coin investment rose by 10% year on year. And the reasons are almost always the same across countries. So there's, inflation risks, and then currency depreciation concerns that drive increased investments, which is called consumption really, but you cannot really consume jewelry, right? You buy it, and many people also use it as an investment, but it's not officially classified as investment, but bar and coin investment is. And then, of course, one of the largest gold mines in the world is the Grasberg gold mine, which is also in Indonesia. So this is just to set the scene, because I know that this is the association. So one of the big questions here is gold, is it a strategic or tactical asset? And a related question, is it insurance or a safe haven? And the safe haven is defined as a place of safety when things go bad, like a safe harbor. And a safe haven asset can be purchased strategically. So you use it as insurance with a fixed allocation, so you don't change that every month, every quarter. Or tactically, which would then have a variable allocation. So practitioner's perspective, that's also important. That was recently the book. I'm not related to that book. I don't get any money, just to be clear. But I read the book and I liked it. And it has that because I've done a lot of work on safe havens, but it was also recently featured in the Wall Street Journal, where they talked about Mark Spitznagel, that investor who has a hedge fund. And that's why I call that practitioner's perspective. And so one of the questions that are addressed by him, and he has that credential as a practitioner, do we use safe havens only to seek shelter until the passing of financial storms? Or are there something more? And one of the big questions here, and I will address that later, is contrary to everything we know from modern financial theory, can higher returns actually come as a result of lowering risk? So the Spitznagel points out that there's not necessarily a trade-off, that insurance, you have lower returns, but less risk. But I show you that it's actually possible to use gold to boost returns, which is partly counterintuitive. And as a fun part, that the foreword here by Nicholas Taleb, or Nassim Nicholas Taleb, is very, very critical of the financial industry, academia. It's very aggressive even, and many of you know that he has written that Save the Black Swan book, right, and coined that Black Swan event. And many people have called the COVID-19 crisis a Black Swan event, even though that is debatable. But my university, the University of Western Australia, has the Black Swan in the logo, which I think is interesting. Because, of course, the Black Swan event refers to a world where people have never seen a black swan, only white swans, and they can't even think of black swans. And when they see one, they're shocked. So that's the idea. Good. So the research questions. What is the average gold holding of institutions? Remarkably, there's not much research, no academic research, as far as I'm aware of, that has looked at that. How do the holdings vary across time, particularly during crisis? So is that a constant fixed allocation, or is it actually changing? What fund characteristics influence gold holdings? One big question here, do risky funds invest more in gold or less? And the fourth bigger question here, how do gold holdings affect the performance of funds, which is, of course, an important component and linked to that, the cost effectiveness of risk mitigation. So an outline, 3 parts. Descriptive analysis, pretty easy, a lot of graphs. Then part 2, the econometric analysis, also try to keep that easy. And part 3 is the cost-effective risk mitigation, which means if I use gold as insurance, is that cost effective in the sense that do I get even higher returns because I can lower the losses? Good. And the contribution to the literature, there's no study on actual gold holdings of financial institutions. No study on the performance implications of gold holdings, so that effective risk mitigation. The existing empirical studies on safe haven and flight to quality are based on or inferred from price changes, but not based on the actual holdings. So this is the first study that does that. And then there's also no study on how risk attitude or aversion affects insurance and safe haven purchases. Right. So in other words, if I have a more risky portfolio, do I then use more gold or no gold compared to another portfolio that is there? Good. So part 1, descriptive analysis. So the gold holdings are based on ETF holdings. There's quite a lot of text here. There's text in the following slides. We get the data from Thomson Reuters Institutional Holdings database, the TR13F. That is, of course, based on those filings, what these institutions have. The sample period is 2004, because this was then when ETFs were created, not before, up until the end of 2018. So we have 56 quarters there. And for some other analysis, we have extended the data up until Q4 2021, which then fully captures the COVID period, right? Which is also a crisis period. And you may think that, okay, when a crisis hits, then you may need a safe harbor, a safe haven, such as gold. We also can classify institutions into different types: transient, quasi, indexes, and dedicated. Don't go too deep into it, but it's interesting that we can do that and have the transient that are more short-term. The quasi indexes have low turnover but diversified portfolios, and the dedicated, they have very low portfolio turnover and very long-term commitment, also reflected in that word, dedicated. And then the ETFs. So we identify 9 gold ETFs which are covered in the TR13F and the CRISP database. And here you see the major names here. The biggest gold ETF is Spider Gold Shares with 32 billion market cap, followed by iShares to Sprott and so on. And they are surprisingly small compared to just in the perspective of the recent crypto mania. That is also, let's say, the crypto mania in 2021, right? So in that respect, then these are small, but now things have changed a little bit. And the biggest holders at some points in time were Paulson, who was in the hedge fund, was in the news a lot because of those strong, relatively large holdings relative to the average AUM. BlackRock is there, of course, holding on behalf, and Bank of America, Morgan Stanley, and others. And so the institutional investors and gold holdings across time. So we have 3 lines there: the gold value or gold equivalent ounces, the red line. And what you see is that, well, there's some fluctuations over time. But when you go into these crises, GFC is the 2008 global financial crisis, and the Eurozone crisis, the green, Brexit, and COVID-19. And what is interesting, I think, is that the gold equivalent ounces held by institutions go up in these events. Right? So it's not that the allocation is fixed, like in insurance, but it seems that these institutions actually use it as a safe haven, reflected in a flight to gold or safety, so that they actually move in, and that's then reflected in the increase in these crisis periods. And again, there's nothing new in showing that gold reacts to crisis, but what is new and what hasn't been shown before is that the allocations actually change and how they change. And then the number of institutions holding gold, not all of them hold gold. I have a table in a minute, but we see a positive trend. So it seems that despite it also claims that gold is old and ancient and it's a barbarous relic, right? So forget about it. So in the digital finance era or century or whatever, we don't need old stuff, like gold. But this is not reflected in what institutions or institutional investors or the smart money do, because we see that it's increasing. And also with the number of institutions, you also see these increases in these 4 crises highlighted. And then we can also compare the gold ETFs with gold mining company holdings, and we can show that it's not a substitution. So there's the correlation is larger than 0.5. Essentially, it is not the case. We were asked that before, that when ETFs were introduced, that institutions would sell gold mining shares and then buy ETFs. It's more that they use it as a complement. And then the gold ratio distribution here, percent of what they hold relative to their total assets. And it's not much. On average, it's low. I will show you that it's 1.7% of those that hold, and there are a lot that do not hold anything, but there are also a lot that hold quite a lot. Right here, at least in some periods, you see that when it's the gold ratio of 0.8 or 0.9, means like they hold 90%, which is a very, very high number. There's not too many institutions that do that, but there are some, and even that is, I think, surprising that some have such large. And if we zoom in, try to get so that we see a little bit closer what's going on at the bottom there, we see that the average indicated by these box plots with the thick black bar, that there is actually like periods where it's clearly non-zero, right, across all institutions. So what we have is around 3,500 institutions, roughly. So you see these in the highlighted there, and the users is the institutions that use gold, that hold gold. So it's 900, let's say a little bit more, like a third, very rough number, right? Quarter or third, and of those, 890 on average, the equal weighted gold ratio, the other highlighted circle down there is 1.66%, so 1.7% roughly is what they hold on average, those that use it. But obviously there's a lot of funds, 2,700, that don't hold it at all. Right? But it's good for us because then we can compare how they perform across time. And then here in the crisis period, we again see what you've seen before, that the number of funds that hold gold goes up slightly from 469 to 515, but also then the median gold equivalent ounces goes up. Right? So the allocation is not fixed, but it is variable, and they even buy more. So the summary of that first part, 900 out of 2,700 institutions hold gold. Large differences in gold holdings across institutions. Average gold holding are 1.7%. The number of institutions that hold gold displays a positive trend. Remember that positive trend, strong indications that gold holding increased during crisis, for example, JHC or COVID-19. And one of the conclusions from this first descriptive part is that gold is not only held as insurance strategically at all times, but also used as a safe haven, what is also called flight to safety, or flight to gold, and that is then tactically. Part two, the econometric analysis, a little bit more numbers here. So the question, essentially the determinants of gold holdings is the first part, and the second, performance of gold holding funds. How do they perform when you have insurance? Is the insurance a drag on your performance? So it's less risky but lower returns, or is it actually improving returns? Which, for example, is based on also what Mark Spitznagel would argue, that this is counterintuitive to the established finance views and perspectives. So determinants of gold holdings, here, what different variables here, and one of the big ones that I would like to focus on is the stock beta x gold. So that means essentially the exposure to systematic risk, the stock beta of these institutions, right? And what we see here with these numbers, when you see my can annotate, I think here, yeah, like here. For example, that negative number means essentially, I also have a spotlight, which I use later, like here. That's not really a spotlight. So when the higher the beta, the higher the exposure of an institution to systematic risk, the lower the gold holdings. Yeah, so there is an inverse relationship, which means if an institution likes more risk, has a more risk portfolio, they tend to have less gold, which is maybe interesting, but also perhaps counterintuitive. One would have thought, well, if you have a more risk portfolio, you want more, a little bit, you want some gold because you want some insurance, but here it seems like, no, it's the other way around. And if you have less risk, you prefer gold. And then we have other variables, like, for example, the assets under management. So that captures the size. So the larger the institution, the less they use gold. That makes sense, right? That may be large, and also for diversified means like you need less of it. Good, and then here the full list also with the ask rates of the log likelihood. And then the market conditions. So not the characteristic of the portfolio, but market conditions. So that essentially says if the stock returns, the stock market falls, the gold holdings essentially go up. That's not surprising. And it's negative for the D10, D5, D1 means the stock market falls. Is in the 10% quantile, the 5% quantile, the 1% quantile, or we also have interaction variables down there. Let me see the spotlight here. Yeah, here interaction variables with the GFC, Eurozone, Brexit, and these are the numbers also negative, which means stock market falls, and that in these crises or in these crises, then the ratio is negative, so stock market falls and the gold allocations go up. And then the new users is, and that's really, I think, surprising to some degree, that we have those institutions that do not hold gold, but only buy it when a crisis hits, that then we also see evidence that the effects are much stronger, right? For example, here, this is the like stock market falls, and that is in the 5% quantile. And we see that for the new users, those that buy then, the effect is much stronger, which is like I'm still a bit surprised that this is the case, and that investors actually do it, because I would have thought that you're always kind of a little bit late, right? But maybe the smart institutional investors are not late. And then the big question, performance of gold holding funds. So how do they perform when they hold it? And so what we see here is, of course, there is a drag on the performance when we look at the raw returns, because insurance is costly, it seems, right? But then if there is something happening, so if we have a strong fall in the stock market falls, is in the 10% quantile, 5 or 1% quantile, or we have GFC, Eurozone, or Brexit crisis, then the performance goes up, right? So then the raw returns are clearly positive, and they are positive relative to those that do not hold gold. Right? So then in the crisis, they outperform those funds that do not hold gold. But if there's no crisis, then they, according to this line here, they seem to underperform. And then when we look at the abnormal returns, where we take out the market effect, we get weaker numbers, but the same sign and same qualitative result that, well, if there's no crisis, or if the market's relatively calm, there's a drag on the performance. But when something happens, when we are in a crisis or in a crash-like situation or turmoil, then those gold holding institutions outperform those that do not hold gold, which is quite, that's then supports why they do it, right? So summary of this part 2, we have looked at the determinants of gold holdings in the first part, and the second part was the performance of gold holdings. The determinants said that the more risky the portfolio is, the lower the gold holdings are, and the other way around. And the higher the AUM, the lower the gold holdings. The firm size of what these the average firm size of what is in the portfolio increases the gold holdings. The number of different industries increases the gold holdings, and the turnover increases gold holdings. And the market conditions say that, well, when there's a crash or turmoil, crisis, then the gold holdings increase. And for the performance, you've seen what happens there, that is negative in normal times, but positive in crisis times, right? Both for the raw returns and abnormal returns relative to the institutions that do not hold gold. And then part 3, the cost-effective risk mitigation. So here, what we've done is forget about these econometric things that look maybe complicated or not, I don't know. But what the question was, what is the total time-independent performance of gold holding institutions? So not distinguishing between crisis or non-crisis, but just for the full sample period, right? And then what we looked at was that at the end of each year, we identify institutions holding gold in their portfolios and count the number of quarters they continue holding gold until the end of 2018. And then we classify them into 5 categories. So holding gold for at least 20% of all the time, 40% of all the time, and so on. And when you see this table here, just in that first line, so what we look at then is the difference between those that have it and those that do not have anything, okay? And we see that just those that have it had it only for 20% of the time from 24 up until 2018. So this is always from the starting is 24 or then in subsequent rows at a later start, always up until 2018. So here the number is positive and it's statistically significantly positive, different from 0, which means that those that hold gold for 20% of all quarters, not at all times, they outperform those that never hold it. And then when you have it for 40% of all times, they outperform it by more and 100% more. So this number is also increasing, as you can see, right? Except for the last 180 or 100% doesn't seem to matter too much, right? So it's the real changes from 20 to 60. So here these that hold gold outperform those that do not hold gold over that whole period, despite the fact that they have something that potentially would argue that drags on the performance, because gold has historically lower returns and actually higher risk than a diversified portfolio. If we then go back, so this is all true, these numbers all remain positive up until 2007, right? Because then you have gold in place as an insurance, also 2008. But then it's smaller here. And then from 2009, the numbers become negative. What does that mean? So if you go in 2009 with gold holdings, but didn't have anything, or the period before was not considered, from 2009 to 2018, the insurance doesn't pay. And why not? So you underperform. Those who hold gold underperform those who did not hold gold. And why is that? Because, well, you need a big crisis to get a benefit out of the insurance, right? I mean, think of your insurance on the house. I mean, I pay like what do I pay? Let's say $3,000 per year on insurance. So if nothing ever happens, the money is kind of lost, right? But of course, if something happens to my house, then I get the payout. And this is essentially what we see here. Yeah, good. So summary and concluding remarks. This study demonstrates that gold is used by institutional investors, the role as portfolio insurance and a safe haven. In this case, we have directly observed it and not inferred from prices, as has been done recently, up until recently. Gold is used as strategic asset insurance and also as a tactical asset. So it's not just that the allocations are fixed, but a lot of funds also use variable allocations. They go in and out. Some people would argue that there's an inconsistency here, right? But And gold used more by lower risk funds than by higher risk funds, which is also interesting. Gold as a strategic asset provides cost-effective risk mitigation because those that hold it at all times from 2004, they outperform those that do not hold it. So that's why I call this, or we call this effective risk mitigation. Then something I haven't really talked about, but which is also interesting, I think tactical characteristic boosts the strategic characteristic. So those funds or investors or institutions that go in a crisis, they push the gold price up. And of course, they help those that hold it at all times. Right? So there is this link between, the two tactical and strategic are connected. They are not independent. And it's quite interesting that the tactical ones essentially potentially transfer wealth to those that hold it strategically. And finally, gold is not a barbarous relic, but widely used by portfolio managers, and it seems also not only widely used, but wisely used by portfolio managers. And that's to lead on to the discussion potentially. It is those that claim that crypto is the future. Well, maybe the future, but there's currently no evidence that gold has lost any of its glitter from an investment perspective or attractiveness because it's still used, and this upward trend is also very strong and counters that claim that crypto is already getting into the gold market and challenging it. Good, thank you.
All right, thank you so much, Professor Bauer, for presenting your recent empirical work on golden portfolio insurance. This one is very interesting, and I hope everybody will be more than happy to engage in the discussion, right? So to the attendees and participants, I would like to invite you, if you have any question and you would like to directly interact with the Professor Bauer, it will be more than welcome. Otherwise, you can also hit the raise hand button, or you can also type your question and post it on the chat box. So if you have any question, I will be welcoming you. So please, you can raise your hand. So I guess just for triggering the discussion, Professor, I will start the first question first, and maybe the other participants also have some issue with, or maybe they have something in mind, right? So you said before, in order to get the benefit of the insurance, we have to get a big crisis, right? So I was wondering, because you already have divided the portfolio holding performance based on some important event like the global financial crisis, the COVID-19 issue. I was wondering what will be the potential outcome if we think about the geopolitical issue due to the Ukrainian and Russia war. So will it be providing us with the same potential outcome, or will it be different, I guess?
Yeah, good point. I think there was an initial reaction of gold when in February this year, Russia invaded Ukraine, gold reacted to it. But that has waned a little bit. And there's, the point is, I think, of the problem, it's not a problem, but there's so much going on today, right? Because we have that invasion, but then we have inflation, which really has huge implications and repercussions on capital markets in general, as we all know, right? And so it's hard to disentangle the effect. I think in the past when we had a crisis, geopolitical risk or stock market crisis such as the GFC or COVID, but then there was not another five factors, right? So now with interest rates going up and no one really knows when the hikes stop, we are in a very special world, which is, of course, from an academic perspective, it's really exciting, right? But it's also hard then to disentangle the effects. So some people are a little bit surprised that gold is not higher, right? Or hasn't really done what people would have thought that that would happen. You know, you have a war, you have a lot of disruptions, you have a lot of uncertainty. So why has gold not gone up by more? That's a good question. But you could also say, well, gold hasn't gone up by a lot, but it hasn't fallen by that much as all the other assets, right? Stocks and bonds. So in that respect, relatively, it has done pretty well.
Yeah. So we are getting ready with the global financial crisis, right? Due to the probably the geopolitical issue is also affecting more countries now, and of course the global economy is in a gloomy condition now. All right. Yeah. So there is one attendee. Yeah, Professor Irwan Adi Eka Putra is raising hand. Please, Prof.
Thank you, Berto. Hi, Dirk. On behalf of IFA, I'm Irwan. I would like to thank you for your willingness to serve as one of the speakers. So my question is this. We see, and a lot of economists and also analysts predict that 2023 will be a very gloomy year for the global economy. And the way I see it, and probably this is related to the previous point brought up by Berto, that I don't see gold prices to be up. My question is whether the fund managers are anticipating or they are reacting. I mean, do they wait until the crisis hits, then they move to gold, or they like anticipate before the crisis hits and then they buy gold? My second question is probably related to a lot of your work on cryptocurrencies or digital currencies. What do you think of stable coins? Do you think they can become like also a safe haven for other asset class? And then probably lastly, this is like an information that Indonesia has not have, to my understanding, there is no ETF in gold ETF in Indonesia yet. What would be the necessary requirement for gold ETF to be established? Is it only the regulation, or there is another infrastructure, like how do we really need to actually store the physical gold to be able to create this ETF? You may answer the last questions, or if you don't have the answer, it's also okay. Thank you.
Thank you. The first question is very interesting because the point is, if you know when a crisis hits, right, you don't need insurance. If I know when my house burns down, or there's some kind of issue that makes my house disappear, or that I lose it, that the value goes to zero. If I know when that happens, I don't need insurance, right? Or not necessarily. And so this is here. If institutions know exactly when a crisis hits, they could anticipate that, and then they don't need insurance, right? That could explain why we have this difference where some institutions hold it at all times and others only hold it in certain periods. Clearly, then, if they only hold it in certain, if they go into gold in a crisis, if they know that the crisis is happening, they wouldn't have to do it to protect their portfolio, right? But then they may go into gold to boost their returns in a crisis. So this is, some people call it a contradiction again, right? So if you know, if you know what's happening in the future, if you know the future, and I don't think that anyone can predict the future, if you know it, you don't need insurance, right? In this case, it's possible that these big institutions or the smart investors, that they are ahead of the crowd. So even if they don't know, they can then kind of sense that something is coming, or even sell at the early stage of the crisis and then buy gold and boost their returns. So that's, I guess, I like the scenario. The second question, stable coins. Currently, the stable coins are, most of them, linked to fiat currency, right? The big ones, Tether is linked to the US dollar. A lot of central banks, also the Australian central bank, is currently piloting one stable coin, which would then be linked to the Australian dollar 1-to-1. So if in this sense, these stablecoins can be safe havens as much as a currency can be a safe haven. It's well established that the US dollar also works as a safe haven. So usually when the crisis hits or something bad happens, the US dollar appreciates. This is also true for the Swiss franc and used to be true for the Japanese yen. So if we think of stable coins that are linked to these currencies, stable coins can also be a safe haven under the condition, of course, that they are as safe as the underlying currency, right? Which is many people would doubt that for Tether, where there have been doubts in the past whether the backing is actually there. But if a central bank issued, we don't currently have that, but if a central bank issued a stable coin that was widely or could be globally traded, then these could work as a safe haven if the link to it is if the currency to which it is linked is also a safe haven. For the Australian dollar, that wouldn't work because the Australian dollar is not a safe haven currency. Is a risk on currency. So whenever something bad happens, the Australian dollar tanks. So in this case, a stable coin linked to the Australian dollar wouldn't be a safe haven, but one on the US dollar and the Swiss franc potentially would be a safe haven. Last question: why does does Indonesia not have a gold ETF, or what are the conditions that must be met? I don't know what the conditions are. Like usually, I guess if there's sufficient demand for it. Plus the regulation that, as you said, if it could be, if the audits were there, that all the gold that is essentially the shares that are issued as an ETF with the backing of gold, if they are involved, and if this can be audited, and people trust that and potentially linked to the government, then that should work. But I'm not sure why Indonesia doesn't have a gold ETF yet, whether that's more that a demand thing or a regulatory issue.
Thank you.
Okay, thank you very much, Professor Bauer and also Professor Iwan. And then let me check the chat box first. So we have one open questions from Christy. Thank you for your elaboration. I would like to ask your opinion. Do you think the stablecoin could be the potential safe havens for other assets other than crypto? So maybe this one is related to the previous question. One. And the second one, furthermore, what will be the future of the stablecoins considering the recent crash of Terra Luna?
Yeah. So I think the future is like, I see a future for stablecoins, and just because one has crashed doesn't mean that there's no future. I think we can, the industry, the space can learn from these mistakes, and I'm sure that there will be stablecoins that will be stable, particularly those I think that will be issued by central banks or governments. So when they are fully backed by a central bank, then I don't see why they could not be stable and trusted. And I mean, we all know that a lot of central banks work on that. Some seem to take much longer. I'm not sure if that is the solution anyway. I mean, I think some central banks just do it because they feel that they have to do something. But anyway, I mean, I'm sure there will be stable coins that will be stable and can be trusted in the future at some stage. It's still pretty early. Like, ironically, maybe, or interestingly early, given that Bitcoin was established 2008, I sometimes wonder why this takes so long. But yeah, so I think there is a future.
Okay. So again, I would like to invite the participants and the audience. If you have any further question, you can simply hit the raise hand button, and then you can also post it through the Q&A chat box. So please. Professor Bauer, is this work is recently being considered for a publication or?
Yeah, well, it's not under review yet because we're still working on it, but we of course plan to submit it to a journal and then get it published at some stage.
To which journal you might probably have something in mind? To which journal you would like to submit it?
Yeah, I'd like to submit it to one of the top journals, right? But that requires then a little more work and time. But I think because there are several aspects that are really new and haven't been looked at, and that's why I hope that it has a chance to pass that hurdle and get published in one of the top 3 or 4 finance journals, right? Maybe Review of Finance or RFS, something like that would be good. That's the plan.
Mm-hmm. So I guess it has a very big potential, right? Because the novelty is pretty clear, I guess.
Yeah, that's what I hope. Yeah, because I think it's really that there is novelty and like there are several aspects of it that haven't been looked at. Right, the data is new, the analysis is new, some of the insights are new, and so I'm hopeful, and I'm also really excited about it because there are things that have not been reported. Right, it's particularly this this tactical and strategic allocation question. The fact that some go in and out, yeah, what that means hasn't been reported because it's hard to infer that from prices, right? And so these aspects are really
Mm-hmm. Again, I would like to invite the participants. If you have any questions, so please. So, because mostly the data is taken from the institutional investors, normally we have institution. Do you think it is also doable for having the individual investor to see their behavior, whether they have to think about whether have to back up their investment using the goal or not? What will be interesting part of it, Professor, if we use the individual investors? Do you have something in mind about that one?
Yeah, I agree that will be very interesting, but it's I guess I would have to get access to some proprietary data from an ETF where it's like, look, these are individuals, right? And how do they do it? Do they act similarly to institutional investors or not, right? So you're right. Or maybe does your question also lead to the idea that we could maybe try to strip out, look at the part of ETFs that are not held by institutions, right? So those could be the individual ones, right? And but then again, we wouldn't know exactly what they would do. But it's a good idea maybe to look at the residual, right? So that part that is not the institutions, and say like, okay, is there some kind of relationship that is similar, or does that mean even that the institutions go up like this in crisis that individual investors don't do that, right? Because then the residual would be that maybe they even sell it. But that's a good idea. We would have to. I mean, I would love that, but the data is always an issue here, right?
Yeah. So that's why that is still one of the open empirical questions, right? And we need to think about how to deal with that, especially about
exactly. Yeah. But it's also what is evident is that individual investors, there's a lot of evidence that in India, of course, anyway, right, China, but also in Indonesia and Germany and Switzerland and in many countries, that individuals, retail investors, they buy gold, right? They use it as an insurance or as an investment, let's say, right? And it's often then claimed that, but they are retail investors, they're stupid, right? Because the smart money wouldn't do it, right? So in that respect, this study also shows something that, even the smart money, right? Even as a response to those that say, the retail investors are stupid, the smart money is also using it, right? Which then lends more support to that evidence and more anecdotal evidence that retail investors use it, and that it's not a bad idea to use.
Mm-hmm. Mm-hmm. Okay, again, I invite the participants.
I was maybe a little bit too fast, right? Sorry for that, but I thought it's better maybe to leave some time for questions.
Yeah.
Can I ask another question if there is no question?
Please, Professor.
Is there any optimum proportion of gold for a portfolio, either institutional or individual, based on your research?
Yeah, I mean, we can calculate the optimal proportion based on different aspects. Like we can use a mean variance, efficient allocation, where the optimal would be quite large. I mean, more than 5% given on the past performance of gold, right? The risk and return relationship. Based on like a market cap approach, where you would allocate the to gold based on the global market cap, right? Then it would be around 2%, between 1 and 2%, which is then the 1.66 that we find is very close to that market cap, right? So that people say, okay, gold has 10 trillion market cap globally. Stocks have, stocks and bonds that have 98 or 200, whatever, and then gold gets the 2%. Right? That's one thing. And then, of course, you can also use a model, and it's good that you asked that question, because Goldman Sachs has a study where they say their model is the gold allocation depends on the budget, because, of course, if investors have no budget to invest, they don't invest, right? So only if they have they can save, only then they put money into gold. And the amazing thing, it's only one study, but it's Goldman Sachs, right? And we all know that Goldman Sachs is quite something. So in that model, what they find is the allocation to gold is 1.7%, which I like that, of course, when I saw it, right? Because I mean, the model says 1.7%, and we find 1.66, right? Quite amazing, right? But anyway. Good. Thanks for the question, because clearly there are different ways to calculate that, and one of the practitioners, again, Goldman Sachs, comes up with something very, very similar, and the market cap would also be very close to that 2% that we find.
Okay, so because we almost reached the time limit, so probably we will finish the second parallel session in a minute. So just in case, I was wondering if the participants still have questions. I will open the very last question, and then otherwise we will close the parallel session too. All right, I guess everybody has, okay. There is one person raising hand. So, but I cannot see the name. Could you please open up your, okay, so this one is Professor.
Yeah.
Yes, Professor, you can deliver your question, please.
Yes, I have a question. How do you compare gold with U.S. Treasury as safe haven asset and also insurance? And then for the gold basically physical asset, right? It's not securities. If they buy gold, do they hold physically or they hold the certificate for the gold? Where is the spot market for the gold? And then the last question, in your result, you mentioned that gold held by lower risk fund, I think. My question, is there any potential endogeneity in this case? Because probably the gold make the fund lowering the risk. Yeah, thank you.
Yeah, last question. That's it's a very good question. Yeah. We strip out we try to strip out, when we look at the risk of the fund, we take out the gold, right, and look at the beta of the fund with the market exposure to the systematic risk. But of course, it is possible that that the risk profile is based on the idea that a fund holds gold or does not hold gold. Right? So there is some indigeneity issue there potentially. Yeah. Good question. A good point. We're a little bit constrained here with based on that we have quarterly data. So any dynamics. So if we had, for example, daily data, it's, with the dynamics lead length, you could potentially try to strip out or find out, mitigate that problem of indigeneity with the quarterly data. It gets harder. It's still possible, but much harder. Second question was so what we do is we look at the ETF holdings because and ETF holdings are certificates on physical gold, but not physical gold holdings of funds, right? Only the ETF holdings, because they have to report it. All kind of securities have to be reported to the SEC, and that's what we use. They could have more gold. It's unlikely that they have less gold, right? But more. So it could be a proxy. It could be a potential underestimate of that. And the first question was, I think, linked to this. I wasn't sure about the first question. I just heard that insurance. So maybe the question was about the distinction between insurance and safe haven, but I'm not sure if that was the question. I can try to answer if that was the question. That insurance we define as a fixed allocation, similar like usually when you have insurance, you don't change the insurance like every day, right? Or every month, right? You have it and you have it for the event, right? Car insurance, house insurance, and so on. The safe haven is more something that is there as a harbor, right? Think of a port, right? For boats, right? So usually if you have a boat, you don't ports were not built for ships to remain in the port at all times, right? So they were built as to load on stuff and offload things, but then also to have safety from a storm, right? And that's the difference. Like safe haven is really something that works in a crisis, but doesn't work at all times, while insurance protects you at all times.
Okay, so finally we arrive in the end session of parallel session 2, and then thank you very much for your presentation, Professor Dirk Bauer. You have been sharing with us very insightful research topic, which is golden portfolio insurance, and this one is very, very interesting for us as the Indonesian Finance Association's members. So hopefully we will see you again in the future agenda, and we wish you all the best with your recent empirical work. Thank you again, Professor Dr. Dirk Bauer. And I give it back to our MC, Miss Yolanda, please.
Okay. Thank you, Mr. Berto. Now we're going to have a photo session first before we end the parallel session for this morning. Please position yourself in front of the camera, Mr. Berto Osman, and also Professor Dirk Bauer, and also other IFA boards. Okay. Please position yourself first and give your best smile. Okay. On the count of 3, 1, 2, 3. Okay, another one. 1, 2, 3. Okay, thank you very much.
Thank you.
Thank you again, everyone.
So, ladies and gentlemen, after this, we will continue with the IFA sessions first and then continue with the break. And after that, we will have parallel sessions as scheduled on the guidebook provided. All of you may proceed to the links provided already in the guidebook and continue for the sessions for today. And then do not forget to please fill the attendance link of each session for today's plenary sessions in order to get the conference certificate at the end of the conference. And also we will present the award to the best paper, also the best thesis in the closing ceremony. We also have 3 smartphones as door prizes, so make sure that you attend each session. Then the door prizes will be given to 3 lucky participants at the end of the conference. So, ladies and gentlemen, hope you have a great sessions for today. We're going to have a break first, and then we'll continue with the sessions with the links provided in the guidebook. Thank you and good afternoon.
Oke, selamat istirahat.
Terima kasih, Prof.
So we will start again at 1 p.m. or 1:30 p.m.
At 1 p.m.
1 p.m. Okay.
Yes.
So we will be start 1 p.m. So we have 1.5 hour.
Yes.
Okay. Okay. Bye bye. See you again. Right.
Recording stopped.